And even if it expires around 940, we'll be earning around 7,500 or more. The risk reward ratio of the strategy is very good, and the margin required has increased because we are entering a short position of put here, right? So this was basically how the different directional strategies can be executed through KEEV. So moving forward, we'll look at the bearish strategies now. So it will be either a put buy or a hedged option strategy of a bear put spread, a call sell or a hedged option strategy of bear call spread. Now let's start by looking at the bearish strategies from the put buy. So here we can see the chart of ICICI Bank from the charting tool of KEEV. So here we can see that the chart is trading near its all-time high, but at the same time it is near a resistance. So if you're of the view that there is a chance that ICICI Bank might reverse from here. So here from the option strategy, we can make a strategy for the bearish view. Let's see how it's done. I'll just look for ICICI Bank here, and then from insert strategy or add position, or let's do from add position from option chain. We can see the current prices of ICICI Bank, and currently since we are trading around, so let's just insert strategy from here. So here we want to look at a normal put buy, right? So this will be a system generated price that will be near the ATM that is trading around 940. So we got a 940 put option on the buy side. So here we can see that it is of a lot size of 700 and it is trading around 2.4. Moving forward, you can see the payoff of the put option from here. As you can see from the chart here, we have undefined max profit but and a defined max loss that is around 1,600. The break even for the strategy would be around 937, which will be approximately 940 minus 3 rupees. That is the premium that we are paying for the put option. And here we can see that margin required is equal to the max loss. That is one of the benefits of going long. The margin required is usually less. But at the same time, we can see that there might be a situation where the max loss is high and we feel that we need a lesser loss and a more defined risk. So for that purpose, we can deploy a strategy that would be a bear put strategy. And I'm looking for that strategy here. So here we can see that the ATM in a bear put strategy, the ATM option is bought and the OTM put option is sold. So just to see a payoff here, we'll check it out. So here we can see that our max loss is more defined, and at the same time our max profit is also defined. So here we can see that the break even of the strategy would be around 938, that would be around here. And in order to be profitable, we need to be below 938. The risk reward ratio of the strategy is very good, and the margin required has increased because we are entering a short position of put here. So this is one way to execute a bearish. So these are basically the two ways to execute a bearish point of view on a stock. And if you don't want to be aggressively bearish, and if you want to see a neutral bearish position where even though the stock option would be around the same price, not necessarily aggressively reducing, then we can see a call sell here. As we can see from this sheet, a neutral bearish strategy would be a call sell or a bear call spread insert strategy there. So here, the system generated would be near the ATM, or it will be either first OTM or near the ATM. Here we can see that it is, I think, first OTM as the spot price is around 941, and the future is around 950. So this is around the ATM. So here we can just see the payoff of a call sell, right? So here we can see that the max profit from the strategy would be around 3,000, but the max loss would be undefined. And in addition to that, the margin needed will also be around 1 lakh rupees and the break even would be 955. So the point of the strategy is, even though the stock price is just trading around 940, 950 right now, even though it goes till 955, we are not at loss because we are giving ourselves a bit of a breathing room that we might be a little wrong and our stop loss will be near that, and we'll be earning profit if the price moves down, as with the earlier strategy. At the end of the day, we are earning from premium here. As you guys would have seen from our previous video, the premium of the stock price that we are talking about is defined by delta, theta, and other Greeks, as the video shown earlier. We'll put a description of that video in the description below. So in order to hedge this, so in order to hedge the max loss and in order to reduce the margin required, we'll deploy a bear call spread. So from the bear call spread here, we are basically buying. So from the bear call strategy here, we are basically buying the OTM, further OTM call, because that will be a hedge to our current ATM or bit ITM call sell. So here the point of this is to have a defined max loss and at the same time reduce the margin required drastically by approximately half or one third of what was required earlier. So here our risk reward ratio is not that great, but at the same time we'll be benefiting from the neutral bearish view. So let's see if the stock prices will be around 940 and if the expiry is going to be around 940, we'll still earn around maximum profit. So as we can see here, the max profit of this trade is around 9,000 of 7,900. And if even if it expires around 940, we'll be earning around 7,500 or more. So the point is basically we're giving ourselves a little bit of breathing room on the off chance that our strategy or our view about a particular stock might be wrong. So that gives us the benefit of the doubt, and at the same time, it gives us a bit more advantage from the risk reward and the risk management point of view. Right. So this was basically how the different directional strategies can be executed through KEEV. Main advantage is the charting tool is here, and you can just view your chart here. You can execute your option strategies here, and it is very easy to execute as we saw. And at the same time, once your strategy is made and you feel that there is a chance that the strategy might have worked in the past and you want to see how it is worked, how it has worked in the past, we can uh, we can see from the backtest here, which we'll talk about more in the next video. So just to conclude, I'll basically give a brief about these names. So here, from a bullish point of view, we can see that the bull call spread, all the three words in the hedged option strategy has meaning. Bull will be your point of view, your view of this particular stock or this particular position is bullish. Call because you'll be using the call side of the options only, and spread because you'll be using two legs. So the bull call spread will be your view, the instrument type used, that is the call, and the spread is basically two legs which you are defining your max loss, max profit, and risk management from that point of view. So here we can see the same in the bull put spread, where the view is bullish, but we'll be using put and spread because there will be two legs to the strategy. And same with the bear put spread and the bear call spread. So in the next video, we'll be talking more about non-directional trading strategies because the this video talked mainly about if you have a bullish or a bearish view or a neutral bullish or a neutral bearish view. So in the next video, we'll talk more about non-directional view and we'll talk about it from the index point of view, the Nifty, Bank Nifty, and I'll show how you can run a backtest on your strategies that you're making here. Thank you very much for joining.